the imbalance, the frightening thing about this is that if you get losing money, and people are losing money by holding bonds, and that's not just Americans, those are other foreigners, then they could sell bonds. And if they sell bonds at the same time as the government has got to sell a lot of bonds, that could produce a real dilemma.
This week, Ray Dalio sat down with Bloomberg to discuss his expectations for the stock market in this year and beyond. And in the interview, he provided a great explanation of how a chain of events that has happened many times in the past will likely lead to a significant stock market crash either this year or soon after. I have organized some clips from the interview to provide you with an explanation of the key economic events that have happened so far, and then what Dalio expects to happen over the next few years. So sit back and relax, and if you do get some value out of today's video, I would very much appreciate it if you could take the 2 seconds to leave a like on the video. And hey, if you get a ton of value out of today's video, then consider becoming a subscriber by hitting that subscribe button below so you get up to date when I post new content. But with that said, let's jump into the first clip.
What we've seen this go around is the need to distribute, to produce a lot of debt. Where did those checks come from? They came from the government. The government wrote the checks, but the government can't produce money. The central bank can produce money. So the central bank had to print a lot of money to lend to the government to do that. And that's monetization. When you get at the late part of that cycle, where you're creating a lot more debt and then you're monetizing it, that's the end of that's near the end of a long-term debt cycle. And that produces its own set of problems.
Over the past 12 or so months, there has been a clear and distinct chain of economic events that is really important to understand. And the first major one, of course, was when the pandemic hit. When the virus started to spread rapidly around the world, many governments started to issue restrictions on certain activities and travel restrictions and restrictions on restaurants and the way that you interact with people. And that had an immediate impact on businesses and individuals. When restrictions were put in place, businesses started to make a lot less money. They therefore laid off employees, and that meant that those individuals had less income and were less likely to spend in the economy beyond the essential spending requirements of that person, and that fueled even more businesses to lose more money and more people to lose their jobs. The next thing that happened was the government saw that there was an income gap in businesses and individuals, and the government increased their spending in order to fill that gap. And when the government needs to provide massive amounts of stimulus to businesses and individuals, they are going to be spending far more than the tax revenue that they are generating from the general public. Particularly when businesses and individuals are making far less money, there is less tax revenue overall to go around as well. And those two factors combined mean that the government needs to take on significant amounts of debt in order to fuel stimulus checks to businesses and individuals. And for the US government to take on new debt, what they do is they issue treasury bonds. So they basically sell these bonds, and the act of someone on the other side of that transaction buying that bond is lending money to the US government.
Let's understand what's behind that. And then you can understand what the warning signs are, because it's just a manifestation. When there has to be a lot of selling of bonds, and bonds don't give any good return, there's a guaranteed negative return in bonds relative to inflation. Inflation index bonds yield minus 1%. And so there's no return. And there's a pile of people who own bonds. And this isn't just Americans, but these are international investors owning bonds. And they have to buy a lot more bonds, because when the government has to sell a lot more debt, that means they have to buy a lot more bonds. There will not be enough demand for those bonds. When that happens, interest rates rise. That's what you're seeing now. And the central bank is put in a dilemma. This is all classic end of cycle type of thing. The central bank is put into a dilemma because either interest rates will rise a lot, or they will have to print money and buy those bonds to hold them down. When they print money and buy those bonds to hold rate down, That lowers real rates and it accelerates a depreciation of the value of the dollar. And it also raises inflation pressures.
In very rare circumstances, the US government needs to issue a lot of bonds. They need to take on a lot of debt. And the last year during the pandemic and continuing on into 2021 is one of those times where the government is doing so much stimulus to fill that income gap and revenue or profit gap for businesses that they are spending huge amounts of money and need to take on huge amounts of debt. And in those circumstances, there is often not enough demand for buying those government bonds at the rate that the government is issuing them. So what happens is, like any other free market where there is not enough demand, the government can lower the price of the bonds, or in other words, raise the interest rate or the interest earned if you lend money to the US government. And if the amount of government debt that is being taken on isn't a huge amount, then raising interest rates a little bit can usually attract enough demand for the general public and funds to want to buy those government bonds. However, in this circumstance, there was so much debt taken on by the US government that there was no way that the public was going to fill that demand without interest rates going up substantially by a number of percentage points. And the Federal Reserve knows that if they let interest rates go that high, that it would start to affect other asset classes and eventually other real businesses in the economy.
The rising interest rates start hurting financial asset prices. First, typically, they hurt bonds. Then they pass through and hurt stocks because still interest rates affect stocks. And when that starts to affect stocks, that's one thing. Maybe the stock market can correct 10 or 15% and the Federal Reserve can tolerate it. When it goes beyond that and starts to affect the economy, that's when you see the real trade-off have to surface.
The way that interest rate rises affect other asset classes such as stocks is in this way. Imagine that stocks are offering you a 6% return and bonds are offering you a 1% return. You are likely going to continue to invest in stocks. However, if bonds are now offering you a risk-free return of somewhere between 3, 4, and 5%, and the stocks you're investing in are still only offering you 6%, just slightly higher, you may now decide that you no longer want to take the massive amount of risk in the stock market for an extra 1 or 2%, and you may decide to sell your stocks and move investments into bonds. And if that broadly happens across a lot of individuals and a lot of funds who are invested in the stock market, it can have a significant downward pressure and downward movement on the stock market. So to prevent the interest rates of government bonds going up as the government is spending and issuing a ton of debt, the Federal Reserve steps in, they pull out their money printer, they print a bunch of money theoretically, and they are buying these government bonds in order to fill the demand. So instead of letting interest rates rise because there is a lack of demand for government bonds, they're able to artificially keep interest rates low by printing money and buying those government bonds at low interest rates themselves. Now, everything that I've explained to you so far is inarguable. This is just what is happening and what has been happening over the past 12 months. But what I'm now going to show you in terms of clips from this interview is what Ray Dalio expects to happen in the future. And this is just Ray Dalio's opinion. This is not set in stone. This is just one opinion of what is going to happen in the economy in the future. And I certainly don't take these as gospel. Take it with a pinch of salt and make sure you get a wide view of opinions on what you think will happen in the markets.
The imbalance, the frightening thing about this is that if you get losing money, and people are losing money by holding bonds, and that's not just Americans, those are other foreigners, then they could sell bonds. And if they sell bonds at the same time as the government has got to sell a lot of bonds, that could produce a real dilemma. That's classic late long-term debt cycle type stuff.
The first thing here to understand is that the money printing done by the Federal Reserve actually puts more money into the US economy. And the way that that happens is the Federal Reserve is printing money. They are then buying government bonds. So in other words, they are providing money, lending money to the US government. And then the US government is spending a ton of money in the economy. They are providing stimulus to individuals and they're providing stimulus to businesses as well. And if enough money is added into the economy, it can start to have inflationary pressures and increase the rate of inflation, meaning that the purchasing power of the US dollar is going down as more money is diluting the value of each dollar in the economy. And the dangerous and fragile part of the economy is if inflation starts to exceed the return that people are generating on those bonds, meaning the real return they're generating would be negative if they hold that bond. And in that circumstance, you can start to see the general public and big investment funds start to sell government bonds at the same time that the US government is selling government bonds. To understand a situation where the real return is negative, think of it like if you're holding a bond that is earning you interest of 0.8%. You're earning a 0.8% return. If inflation in that environment was 4%, meaning the purchasing power of the dollar is declining by 4% per year, then holding that bond is earning you a negative 3.2% return. So if you have a situation where there is no reason for anybody to hold a government bond because it will be losing you money, then you can have a scary situation where not only is the government issuing and selling bonds because they're spending a ton of money to stimulate the economy, but you might have individuals also selling bonds, meaning that if the Federal Reserve is going to hold interest rates down, they now need to start printing a ton more money and buying government bonds, not just from the government, but also from the general public. And that can also accelerate the rate of money flowing into the economy and therefore accelerate the rate of inflation. So what does Ray Dalio see happening through all of this in 2021?
So it's a difficult dilemma, and it's a particularly difficult dilemma that I think that you're going to see, particularly the late this year and beyond that, because late this year, you're probably going to see everything be a problem. You're going to probably see higher interest rates because growth will be stronger, inflation will be stronger, and that you'll see probably there won't be enough demand on it. So the thing to watch out for as a signal, if this happens, is that you see the need to buy bonds when the economy is strong and when inflation. If you take, there's this year and then there's beyond this year. There's the next few years. It's a problem because how we're going to spend money is a political issue, a big political issue. And we're going to have to, and there's going to be too much spending. And so that'll affect the value of the dollar and or interest rates.
Ray Dalio expects to see a combination of inflation from money printing as well as higher interest rates from the oversupply of treasury bonds. And as a stock market investor, you might wonder, how does that impact your stock portfolio? This seems to only impact bonds or treasury bonds. Well, treasury bond yields going up first then affects other bond yields, corporate bonds, and then it affects the stock market because the vast majority of investors, big funds, big mutual funds, big hedge funds, the vast majority of them are using that treasury yield interest rate as a yardstick to compare investment opportunities. And whenever the yield goes up on the US Treasury, the yield on stocks also goes up. And saying that the yield of an investment is going up is the same as saying the price of it is going down. Right? So if the yield is going up for stocks because the yield is going up for treasury bonds, that means there is downward pressure on stock prices, because ultimately the most basic way to understand it is if the yield, if the return that is achievable on a government bond is going up, then you're more likely to sell stocks and buy government bonds and secure that risk-free alternative. At the moment, that risk-free alternative is about 1.6%. It is terrible. So you would, in most cases, be willing to buy stocks to achieve even a slightly higher return. But if government bonds are starting to deliver 3% returns, 4% returns, then it's a different story. Then you may not be willing to pay 50 or 100 times earnings for a company, you may want to sell that company and just invest safely, particularly if you see some weak economic conditions coming in the near future. So I hope you guys got some value out of today's video, and if you did, I would very much appreciate it if you could leave a like on the video. I'd love to hear your thoughts down in the comment section below. I'll be answering questions and comments as this video goes live. And as I said at the start of the video, if you've been enjoying these kinds of videos and you want to see more and stay up to date when I am posting, then make sure you hit that subscribe button. It is completely free. And if you hit the notification bell, you'll be notified when I am posting new content. But with that said, I hope you guys have a great day, and I'll see you in the next video.